Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 19th, 2017. Wanted to do an update, cover the broad markets. I've really been focused on gold and select commodities, natural gas, some other things recently. And there's still opportunities there. I've covered those extensively recently, so I don't plan to touch on those unless I can wrap this video up, keep it short. Maybe I'll touch on them, give you a quick update at the end. Otherwise, check out the video that I posted yesterday or any of the recent commentary, both on the front page and in the trading room. All right, broad markets. All right, so there hasn't been many significant developments. As we all know, we've been in an unprecedented low volatility upward grind, slow and steady. Volatility has reached all-time lows we've never seen in the history of the VIX, if I'm not mistaken. Volatility reached such low levels. Um, and so that's that. Nothing lasts forever, as we know. And one thing we also know is typically from periods of low volatility emerged, your corrections. So we don't have any any type of sell signals on the long-term charts, but I do want to touch on those because I've lived in the world of the 60-minute charts in recent months for a while because of that low grind. When you have very low volatility and a steady climb higher, there aren't any new technical developments to report on the weekly charts or the daily chart. However, I feel super strong on this. It is very important in trading to always keep an eye on all time frames and never lose track of the big picture because this is where the big moves can come from. And let me tell you what I'm talking about here. This is a weekly chart, 10 years. So we go back the last decade and it shows you every divergent high that's been put in on QQQ. By divergent high, I'm talking about negative divergence, lower highs on the indicators down below versus higher high on prices. So you can see the corrections, 17%, 13%, 26, 19, and now we have the first divergent high since all the way back in late 2015 with that last 19% drop. There it is. Now, we do need to see this divergence confirmed. This is, a term I use. I like to say that divergence is potential, while the PPO or whatever indicator, if you have a signal line like the PPO or MACD. In this case, the PPO is still moving up, and we haven't yet put in a lower low. As long as we put in a lower low um, or equal low, uh, compared to this early June 2017 reaction high, then we have the negative divergence. And it'll be confirmed if and when this PPO line, that orange line, crosses down below the signal line, because then that will effectively give you your peak once the two cross. So there it is. Potential divergence, I believe it will be confirmed. We have the divergence also building on the RSI. And the important thing here, a divergence is just an indicator of a potential trend change. And as I often say, they play out much more often than not, especially when you get out to these longer term time frames. And again, that's when they're confirmed. They play out much, much more often than not. In this case, every one of them's played out for a correction of over 10%. Um, Now, the significant thing that stands out to me, we had this uptrend line here. It was well defined. When we broke it, you got that waterfall sell-off. That tends to happen on these very significant, weekly time frames. And again, I haven't focused much on this lately because of that low volatility grind, but I'm not taking my eye off the big picture. And what I see, and I've showed you this chart. I've had this trend line. It's a very well-defined trend line off that reaction low back in 20 late, the fall of 2015. We've walked up that trend line, and the important thing, that trend line is now only about 3.5% or so away, less than 4% below. And although I'm not expecting a drop of 3-4% one day, let me say this: it is very, very possible. In fact, drops of single day drops of 3% and even greater are not unusual. And in fact, they're more of the norm when you have these, when the market finally breaks and you get that waterfall sell off. We don't have those sell signals yet, but they can come at anywhere. They can come this week. They could come, 6 months from now, 8 months from now, anywhere in between. But I give you my word, the markets historically, that's what happens, especially in the higher beta, higher volatility QQQ, with a lot of tech stocks and everything else. So my point here is be alert, be aware. You don't have to short the market in anticipation of a break of this trend line. But here's your bull trend. When that trend line's broken, that will be very significant. There will be a lot of eyes on that trend line. This is a very obvious trend line, just as this one was here. And when you got that weekly, when finally broke it and closed below it on a weekly basis, we had just a waterfall sell-off. Came in, we back tested from low to the penny. And again, these lines you can look back, put them on your chart. That's technical analysis. I can tell you this. Technical analysis during a steady upward grind, people are just buying, they're buying any dip. Technical analysis works infinitely better during sharp sell-offs and corrections because fundamental analysis is thrown out the door when the market's in meltdown mode. The analysts aren't worried about spreadsheets, future earnings. At that point in time, the professionals, retail traders, everybody, they're looking at charts. They're looking at support and resistance levels. If the market's in a free fall mode, they're watching where's a key support, where should I step in and buy. And same thing on the bounces. Okay, we have a bounce, things are getting ugly. I need to get out where I'm going to sell. That's when technical analysis works great. So keep that in mind and just watch this trend line. Again, it's only technically speaking one bad day away. Now, I don't think we're going to get there in one day, at least not at this point. I don't see anything glaring in the charts that stand out, but I just wanted to point out how precarious we are as we walk up this line, and risk and fear have totally all but left this market. Let's look at the daily chart. We'll look at SPY real quick. This chart on SPY, the weekly chart, isn't as ugly as far as divergences. We do have potential negative divergence still unconfirmed. We do have a well-defined uptrend line that we're only about just over 3% below on this trend line here. So again, one bad day away on the SPY, boom. But we are at the most overbought level that at least in a decade. This chart goes back a decade. You can see we've never even come close to this reading. You probably can't make it out in the video. That's about 84.88. We're at almost 85 on the weekly RSI, an extreme reading, and we could probably go back decades, possibly throughout the history of the S&P 500. I don't know if we've been that overbought. So just keep that in mind. That's typically when you get overbought, that marks at least a pullback. So we'll watch. All right, let's go to the daily charts here. And again, my big focus has been on QQQ. It's led this market up, and as we know, a handful of stocks within the Qs, the FANG stocks, have done that. All right, so this is a daily chart. Real busy chart. Forgive me, I haven't cleaned this up. I do have other boards. Let's see if I can find a cleaner board. No, nothing that not that I wanted to, nothing that stands out. These are just micro levels that I look at. If and when we finally get the next pullback, I'd have to put another line here. These are just levels that I'd be looking at. Not necessarily that I'd look to cover at each one, but I would certainly look to cover if there are certain developments that I see on the shorter term charts as well as the daily charts here, divergences, selling climax, bullish candlestick reversals, things like that. So these levels are there for a reason. If I see prices approaching, and again, especially if you're a short side trader, because stocks tend to fall much faster than they rise. Case in point, look back here, there was a drop. This correction here, 26% drop, happened in about 1.3 months, if I'm not mistaken, and that wiped out 1.3 years of gains. That's how much of the gains. You can go back all the way to this point here, and it was wiped out in just over a month. So, and that is that it's not super extreme. It's extreme for this bull market, but it's a little bit of extreme example, yes, in this over this time period here, but we certainly saw that back in 2007, 2008, even in late 2009. And other points in the market. And there's a drop there. You can see that happened in just a couple weeks that wiped out. I have to move up here so I can measure going back to this point in time. Just a couple weeks, we wiped out 10, 11 months, 10 months of gains right there. So case point that I'm trying to make here is that, be ready, have your plan of attack ready to go. And if you're a long side only trader, that's fine. Just be ready when you see these key support levels crack. Again, whether it's this year, next year, or any time in between. I doubt it's going to go much more than 2 years before we see this trend line crack. Anything's possible. But just be ready to, set some stops. pull the plugs or buy some, protective. If you wait to buy put protection after we break this and you start to see this waterfall sell off, it's just not feasible. So, member Art in the trading room made mention the other day that it's a good time to hedge up via puts. You can buy put protection on your longs, and the time you want to buy puts, I'll tell you when you want to buy puts and when you don't want to buy puts. Sorry, wrong one. VIX. Okay, here's the VIX. This is a daily chart. Oh, we'll go back to that weekly chart we were just on. It's very simple. Very, very simple. This is when you want to buy puts. This is not when you want to buy puts. Not here, not here, not after volatility is spiked up because you're paying an exorbitant a premium, volatility premium they call it on those puts. But down here, puts are cheap. Puts are on sale. They've been on sale for a while. And again, if you're buying naked puts, those puts were expired worthless. That means you were betting on the market to fall without any other offsetting positions. But again, for a long portfolio, dividend income investors, that's not a bad way to go. And again, this shaded box here marked the historical low end of the range. So, up and for years, this is where you wanted to buy puts down at the bottom of this range, and this is where you wanted to sell puts or remove your put protection. But all right, that's that. If you don't know anything about it, you have to read up on it. Otherwise, just stay out of puts. If you think that the market has run its course for your long positions, either set stops, hard stops, trailing stops, whatever you want, or just get out. There's nothing wrong with being in cash. Um, okay, let's just go back to the Qqq charts and we'll wrap this up. So here's that Qqq Daily Chart. What stands out to me, again, this right here, you can see these are different divergence lines, but the most significant ones are these current divergence. You can see the indicators, the RSI and the PPO really starting to drop off with this most recent advance that I've highlighted in purple there. PPO is pointing up, so that is bullish. Again, that's not confirmed, but if we start to see a correction, and I'm going to get down to the 60-minute charts and show you we may get one here soon, and we confirm this divergence, meaning that PPO makes a bearish cross, then you have a pretty nice divergent high. And again, you can see that these have played out in the past. Divergent high, divergent high, divergent high, and there were your corrections that followed. So trade it as you like. There was one just before that, divergent high to the left of the chart. And I think that would bring us down to that primary uptrend line, that same trend line that I talked about a minute ago on the weekly chart. Here it is. I believe this is the same trend line here on the daily chart. And now we go down to the world of the 60-minute charts. And this is what I call a swing trader's friend, or at least my friend. I like this 60-minute chart to try to look for these divergent highs and lows. And you can see, they've usually you have a little bit of a higher failure rate here on the 60-minute charts when you have confirmed divergence, but still much more often than not they play out. So there was a minor divergent high, there was a correction, there was a divergent high, there was a correction, divergent high. You get the picture. Wash, rinse, repeat. There's a divergent high. Now this is just an expansion of this existing divergence that has been building since that's late October, about October 30th. And so far, we have not made higher highs in any of these indicators down here that I'm using. And so there's your existing divergence. Now, this is what I would call a major divergent high. Back here, it was a minor divergent high, led to a minor correction. A little bit bigger divergent high as these divergences continue to build. This was an extension, bigger correction. I've talked about these targets for a long time now. We punched out, and I didn't want to see that, but we did see it, and I did make mention before we even took out these highs that if we did so, until and unless these previous highs were taken out, it would do so on a divergent high. So that's the case now. We're starting to reverse, but here's where we need to go. Let's look closely here. All right, we had a gap to backfill, which we did. We backfilled that gap today. This is today's opening candle, this one here, and then some. Now we slice through it. Gaps, once backfilled, usually if the bullish case was alive and intact, you would see a reversal there. And we still could. The 60-minute candle is not finalized. So at the end of the day, if we can crawl back up here, hold above that, then we've backfilled that gap and left no unfinished business. So that leaves the QQQ's room to go on and rally. However, if we close below that, that's a not an all-in sell signal, but it's a bearish technical event because a gap was backfilled that should have held as support with the resumption of the uptrend. So if we close the day, and if you want to try to get in a little jump start here on a short position, if we close even a 60-minute candle below that bottom of the gap there, 157.83 roughly, then that's bearish. We also have this minor uptrend line. There's hardly any reactions. We only have a couple reactions there, but it's something to watch. And then this is really my next support level to watch, 156.70. I think we're going to go down there this week at minimum, and I'll be watching to see what happens there. If we hit that level, I would expect a reaction there. Now, is it just a fleeting reaction with another leg down and we break that support? That would be quite bearish. Bullish, obviously, if we come in and test it and we take off, because what we're doing, that the reason that level is significant, this was a breakout. This was the previous highs. You can see there we went up, challenged it, and fell back. Finally, we went through there and we took it out impulsively. Nice big green candle, some good volume. So that is a breakout to new all-time highs. And I know this is sounds like a broken record. That's all the market's been doing for months now. But here's the thing, one of these breakout to new highs will fail. Any breakout that fails, meaning prices move back below the breakout level, that's a failed breakout. If it's a long side breakout, they refer to that often as a bull trap. Bulls rush in to buy the new highs. It's bullish when any security or index breaks out to new highs. But if we fail this scenario here, that's bearish. And that opens a door up for my targets, which I still think are going to be hit. And that is the 150. Oops, sorry guys, wrong tool. I need an arrow tool down here. Click on that. So there it is. 150, 120 reaction there. That's my minimum target. And if things get ugly, 149.21. But again, remember that as I showed you earlier, the charts are stacked. So if this 60-minute scenario plays out, let's just see what happens. If we play out for a move down to 151.20, and then I have 149.21 there, let's go all the way out to that weekly chart and see what happens. 151, what was it? 151.20 puts us right there, really. Actually, right about on that trend line. You can see it right there. I'm holding the crosshairs. If we got there within the next couple weeks, week or two, we're right about that 151.20. So this meshes well. We're at the top of that sort of almost a price channel here, an upper trend line you can look at. So we're at the top of that. There's potential divergence. So there it is. That would be and of course that's a nice swing target. So that first target around 151.20, and that would bring us down to that weekly support line. It would also mesh with my scenario of a bounce there. That may be it for now. We could push higher within this wedge, or maybe we get a minor reaction and then we go down to break. But if we broke down below and then went below this trend line, and again, you have to have a weekly close, not an intra-week pierce. Here's what happens when you trade off the weekly time frames and you try to take a sell signal on an intra-week break like we had here. You get ramped back up. There's another one right there. I can see a little candlestick shadow. So when trading off the weekly time frame, always wait for a weekly close below for your sell signal, just like on the 60-minute chart I just talked about a minute ago. Let's see what this 60-minute candle does, and we'll go from there. All right, so those are levels to watch, and I'll wrap this video up with the semis because the semis are a big part of the tech world, techosphere. They've been the big driver behind the latest advance for about the last year now in the tech sector. And here's that 60-minute chart. We had this bearish rising wedge. There was a breakdown, flagging action, hit that bear flag measured target, came back up. We back test the uptrend line from below. This uptrend line even goes back a little farther. I think I can go here to a 2-hour chart. Yep, there it is. So you can see a well-defined uptrend line. We came in, back tested, were rejected. Came up again, we back tested, and when we back tested, I made mention of this the other day, we not only back tested that trend line, but we also back tested this 173.55 resistance level. You can see there, it capped all these pullbacks right here. It capped this advance right here, so you have a lot of reactions there. We had a reaction there. Once that level was broken, we failed on the back test. So this is a pretty significant resistance level right here, and that's my point. I love to see, if you're, a short side trader, you either short a break of support as you did here and catch that move down, Or once you believe that there's more in the trend, more to come, then your next step is to short kickbacks to resistance. And that's what you did here. We did have resistance and a back test of the trend line. It fell back a little, but we've pushed back up. One more back test of that trend line and another even more significant resistance level. So as far as, being objective, I'm not going to say this is a 10 on a scale 1 to 10 because the indicators are sort of mixed, but you can see the PPO rolling over here. I can just say this, it is objective. Does it get better? Certainly some trades can get better than that, but I'd say that's a pretty high probability short entry. If you're looking where to stop out, if you short the semis or add on to a short on the semis here, just over 177, there's some minor resistance there. Certainly a resistance line there, but if we get this close back to those highs, it's not going to look good. Let's just see what happens here. And again, the bigger picture too, don't forget, this is the trend line that's super well defined, goes back 2 years. This is a rising price channel in SOXX, the Semiconductor Index ETF. There it is. We hit that trend line and just, almost to the penny and reversed. You can see the reactions back here, reactions there, reaction almost there, bunch of reactions there. This is it. So swing traders, buy support on the bottom of the channel. You can also trade off the top of the channel. You can trade off the midpoint, as I've talked about in the past. But the big sell signal, the one where you can, with a fair degree of confidence, put a short trade on the semiconductor sector and hold that for many weeks, possibly months or more, will be on a break of this trend line. Whether that's the catalyst that sends things down, or we come and back test it, we'll just have to look at the intraday charts. If that happens, if we get a break of this trend line, we'll zoom in, look at the 60-minute charts, 30-minute charts, 15-minute charts, try to see if that's going to be it, or if we get a kickback rally. But you can see these are all targets down here, 150, 150, and I think at least minimum, bare minimum, when that channel goes, that would be a reaction there. But I think we come down here at about the 139.50. 139.50 all the way down to about 138 or so is where a break of this channel will ultimately bring us in. From where we're at right now, that's a drop of about 21%. All right, let's leave it there. Again, until and unless that happens, the trend is bullish. You're looking at a potential, not yet confirmed, but a potential bullish cross on the PPO here. Sometimes you see these attempted crosses. You see prices get rejected. But again, this will be your guide for now. Game and trading off these levels. Short here. Next target, if you were to short here with a stop above 177, I think you can look for a swing down to about 158.89. But again, that's where this comes into play. If you break that support, then you might as well hold on to that position and try to, hold on for a run, allow it to be a potential runner trade where, it continues down for weeks or months. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.